Good morning, dear learners, and welcome you all to the next lecture of my course on financial literacy. This is week 10, where we are discussing the introduction to the stock market, and I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, Banaras Hindu University, welcome you all to the lecture number 47, where we are going to discuss about initial public offerings and follow-on public offerings. In this lecture, we will be going to discuss the conceptual parts related with the initial public offerings and its various types of IPOs, and we are also going to discuss the process with the help of which the companies can raise initial public offerings in the market. Here we will be also going to discuss the various benefits of the initial public offerings, and after that we will be going to discuss the concept of follow-on public offering and the various steps involved in the FPOs. We will be also going to know the various benefits of the FPOs, and we will be also going to analyze comparatively the concept of IPO and FPO, and we will be also understanding the procedure how to apply for an FPO. So, let us start with the first topic, that is the initial public offerings. So, in the previous modules we have discussed about the new issue market of the secondary market, where we had discussed that in the capital market where we have the new issue market, the new issue market helps into the launching of the IPOs for the company. In initial public offerings or IPO is basically the process where the company can issue their shares for the first time into the financial market. So, basically IPO is one of the entry point for a private company to become a public company, and it helps the company to invite the general public to subscribe their shares and financial instrument for their issues. So, whenever a private company needs to raise a larger amount of financial resources from the market and they list their share into the stock exchanges for announcing their IPOs, then that process becomes the initial public offering. So, here the private company that needs to raise larger amount of capital and is capable of dealing with the general public or the shareholders, they can offer the initial public offering and transform from the private company to the public company with the help of the stock exchanges and the financial market. So, here we can see that the initial public offering starts with an idea where the private company with the help of the innovative ideas and the plans related with the modification and expansion of the business tries to accumulate or procure more funds from the market. So, they want to issue their shares for the general public in the market, and with the help of an investment bank or an underwriter, they very easily can get good advertisement, or you can say the financial support into the market, and they can allure the prospective investor to get the money or the savings of the prospective investor for their company. So, shares are allocated to investor with the help of the investment bank or the underwriter that acts as a link between the company and the IPO investor, with the help of which the IPO investor can also give their money to the company who is issuing the shares into the market. So, with the help of the issue prices, the shares are then purchased by the IPO investors and the money is transferred from the investors to the company for the purpose of investing the money into the corporate, or you can say the economic activities. After that, the shares are traded on the stock exchanges for the purpose of making it possible to maintain the liquidity of fund into the market. Now, let us understand the various types of IPOs that are available to us, with the help of which we can also invest into the new companies, or you can say the companies, those who are now going from private company in the public company. So there are mainly two types of IPO. One is known as the fixed price offering and the second one is known as the book building offering. In the fixed price offering, the issue price that the company set for the initial share sales is the price at which the shares will be sold. So the demand for the stocks can be known only after the issue is closed. So any investor who is participating in this particular IPO must pay the full prices of the share that has been announced as an issue price by the company. Whereas in the book building process, the company offers a 20% price band on the stocks of their share company, and the interested investor bid on the share and specify the amount that they are willing to pay for each share. So the lowest price here is referred as the floor price and the highest price is referred as the cap price in the book building process. And through the book building process, the demand for the shares among the public can be known in advance through the bidding process that is done by the different prospective investors into the market. Now, let us understand the process of raising the funds through the IPOs by the companies in the stock market. So, first the companies need to appoint an investment bank for the purpose of launching their initial public offering. So, here we had seen that the IPO, those who are having an idea of modifying or expanding their existing unit and they need higher financial resources, they can contact with the banks or the investment bank for the purpose of launching their IPOs into the market. So they first appoint the investment bank that is involved in the issuance of IPO into the market, and this investment bank or underwriter works as an intermediary between the investor and the company. So they assure the company that in case when the full issue will not be subscribed in the market, the remaining portion that is not subscribed will be subscribed by the underwriter on the investment bank. So this guarantees that the company will receive the required amount of financial resources for their company in every case. So the experts also study the crucial financial parameters of the company, and on the basis of that they become the underwriters of the company and sign an underwriting agreement with the companies. Next is the filing of documentation. So the company also need to file with the multiple kind of documents, and they also need to fulfill various criteria. So first the company needs to prepare a red herring prospectus. So the draft of red herring prospectus is submitted with the registrar of the company, and with the help of the legal and financial experts, such kind of prospectus is prepared by the company. So basically the red herring prospectus is a document that outlines the company's financial performance and financial plans and policies, their business model, the risk and various terms and conditions of the initial public offering. So you can very easily observe that with the help of the red herring prospectus, you can have each and every information about the company that will help you to take your financial decision making. That means whether you want to invest into the company or not, that can be decided on the basis of this document. So it is submitted to the registrar of the company and SEBI for the approval and is considered as a mandatory document for launching the IPO into the market. Now the next procedure is of verification. So after filing the red herring prospectus with SEBI, once it is verified by the SEBI, the approval is given and the verification process is considered to be completed. So SEBI first verifies whether all the information provided by the company is correct or not, and accordingly the approval procedure is done. After that, application to stock exchanges are made. Since the company's issues will be listed on the recognized stock exchanges, the company must make an application to the stock exchange for the initial issue of the share. After that, roadshow is done. By roadshow, we mean it is a time to inform or make the general public aware of your existing. So once all the legal formalities are completed by the company, they need to make public aware about the launch of their IPOs through the various platforms available to them. So they can take the help of various online platforms, as well as offline medias can also be chosen for the purpose of creating awareness about the IPO. So basically it is a marketing and advertising tactics with the help of which they can attract the potential investors for their company. Then the next procedure is of pricing. So pricing of IPO is done. The company now has to decide the price of the issue. So this can be done either through the fixed price method that we have discussed or through the book building process. So both of the methods can be chosen by the company depending on their condition. After that, allotment of share is done. Once the pricing is finalized, the last stage is to allot the shares to the subscriber of the issue. In case if there is oversubscription, then partial allotment is made. If there is undersubscription, the money is then given by the underwriters or the investment bank, as they have guaranteed the company to subscribe all the remaining portion of their IPO that will be not subscribed by the general public in the market. So this is the procedure of launching an IPO by the company in the market. Now, let us understand what is the benefits of raising the funds through the IPO in the market. So the first is that they become capable of raising the capital. So for the private companies where there are a limited number of shareholders and limited finances are available to them, it is a good opportunity that they can raise capital by selling new shares to the general public, and they can arrange some additional financial resources. So this capital can help the company in the future expansion and growth of the company. After that, it improves the public image. Whenever a company goes public and issues shares to the general investor, it enhances the company's image and credibility in the market. Since before the launch of the IPO, you need to fulfill multiple kind of legal and other criteria that are issued by SEBI. You need to disclose various information and fulfill the transparency criteria that is announced by the SEBI. The credibility of the company increases into the market. In addition, since an IPO is underwritten by the underwriters and the investment banks, it also improves the perceived viability of the company in the eyes of the prospective investors. Now, the next benefit of raising the funds through IPO is the liquidity. IPOs provide liquidity for the early investors, that is the founders and the employees of the company who invest into the company, by allowing their shares to list into the stock exchanges and have a platform, that is the secondary market, with the help of which the liquidity of the shares can be maintained. So this can be particularly valuable for all the new startups and early stage companies, those who are facing the lack of finances in the initial stages of growth. Next is employee motivation. Companies can also use stock options as a form of compensation for the employees. So IPOs provide them with a platform of giving a stock option to the employees. So it also helps them to give a chance to providing them with incentives to contribute into the growth and success of the business. So these are the various types of benefits that a company can have by arranging the funds with the help of the initial public offering. Now, Next, we are going to discuss about the follow-on public offering. So, we had discussed that initial public offering is the case where the company issues their shares for the first time into the market. As the name suggests, follow-on public offering is a method of floating the shares in the primary market, where the companies who have already listed their shares into the market, they issue some additional securities or shares to the general public for arranging some more quantum of finances for their company. So, FPOs is a way where the already listed companies in the stock exchanges, they can issue additional financial instrument with the help of the follow-on public offering. There are two different methods of the follow-on public offering. One is known as the dilutive follow-on public offering and the another one is known as the non-dilutive follow-on public offering. So, as the name suggests, the dilutive public offering dilutes the holding of the existing shareholders by increasing the number of outstanding shares in the market. So, basically it leads into the dilution of ownership for the existing shareholder in the stock market, whereas in case of the non-dilutive follow-on public offering, the ownership is not reduced of the existing shareholders of the company. So, basically the shares are issued in non-dilutive FPOs are those that are already in existence in the market. So, existing shareholders such as the promoters or venture capitalists, they sell off a portion of their holdings and thereby they increase the liquidity for the company and their shareholdings are also not reduced. Now, let us understand what is the follow-on public offering. So, whenever any additional shares are issued after launching the IPOs into the market, then it is known as the FPO. Now, let us understand it with the help of an example. Suppose that many Indian enterprises, those who are using FPO, they can obtain the extra money by issuing new shares. So, we can take a example such as Ruchi Soya, which was owned by Patanjali, is one of the case that has used the FPOs. So, Ruchi Soya wished to acquire more cash and it also published their FPOs on the March 24, 2022. So, that was open for the investor subscription until the March 28th, 2022 and the shares had a face value of rupees 2 and it was priced between 615 to 650 per share. The FPO had a lot size of the 21 shares with a total issue size of 4,300 crores rupees. On April 8, the shares were listed into the stock exchanges for the purpose of arranging the finances with the help of the follow-on public offering. Now, let us understand the various steps that is involved into the follow-on public offering. So, in the follow-on public offering, the first step of issuing the share is to appoint an investment bank. So, as we had discussed in the IPOs also, the first step is the appointment of the investment bank or the underwriter. So, here also for the issuance of an FPO, the company need to appoint an investment bank or underwriter to ensure the guarantee of the subscription of the shares into the market so as to attract more and more prospective investors. After that, they need to take regulatory approval. So, the company needs to again file a draft, that is the red herring prospectus draft with the SEBI, that is followed by the red herring prospectus after receiving the approval of the SEBI. So, first you need to submit the draft and then you need to issue the red herring prospectus into the various platform with the help of the SEBI and other regulatory bodies. Then price band fixation is done. So, a price band is set for the FPOs often with the help of the book building process where the investors can place the bids for the purchase of the shares into the market. After that, offer period is given. The FPOs are open for subscription for a time period of 3 to 4 days, during which the interested subscriber can subscribe to the shares that has been issued into the follow-on public offering. Then the allotment and listing takes place. So, after the time period of the offer closes, the company then finalizes the procedures related with the allotment, and the shares are credited into the investor's demat account. And again, if it is oversubscribed, then the subscription is done on a pro rata basis. If it is undersubscribed, then underwriters comes for the purpose of subscription of the shares into the picture. Then next step is of post offer monitoring. In the post offer monitoring, the company ensures that the raised funds are used as that was promised in accordance with the stated goals. That means in the red herring process, for whatever purpose you had asked the money from the prospective investor, for that purpose only the money of the FPOs must be used. Now, let us understand the various benefits of investing into the follow-on public offering. So, by having or the funds with the help of the follow-on public offering, or by investing your money into the FPOs, you can have these different benefits. Number one is additional capital. All the companies who use FPOs for the purpose of modernization and expansion of their existing enterprise, they can raise additional capital and they can assure the growth of their business. So, all the research, development, expansion and modification procedures can be done with the help of follow-on public offerings and raising long-term finances for the company. It increases the liquidity. By issuing additional shares in the market, FPOs enhance the liquidity of the company. So, they have more ready cash with them for using it or investing that money into some new opportunities that are available in the market. Next is it enhances the credibilities. FPOs can improve the company's credibility and they can also increase the company's reputation by demonstrating its ability to raise the capital from the public markets. Next benefit is it helps in the merger and acquisition. So, the companies that are planning to acquire the other business or their asset, they may use FPOs to quickly raise fund for the larger amount of capital that is required for taking such type of decision of merger and acquisition. Next is debt reductions. Companies that are burdened with a high interest loan and they are not capable of fulfilling the requirements related with the payment of interest and payment of principal amount at the maturity of the loan period, they can use FPOs to reduce their debt levels. So, they can thereby improve their balance sheet and credit rating with the help of launching FPOs into the market. So, these are the various benefits of the FPO. By raising the funds with the help of the FPOs, the companies and the investors may have these following benefits. Now, let us understand the difference between the IPOs and FPO. What is the difference between the IPO and FPO and how it can be helpful for the companies under the different kind of situation. So, if we talk about the meaning, IPO is a way through which the company issues its shares to the general public for the first time, whereas in case of the FPOs, an already existing company on the stock exchanges issues some additional shares into the market to raise the capital. So, simple difference between that, the IPO is raised at the first time into the market, whereas in case of the FPOs, there are additional shares that are issued by the existing company into the market. If we talk about the disclosure requirement, the IPOs require intensive disclosure of all the documents that is always subject to strict scrutiny, since the company is getting listed into the stock exchanges For the first time, they need to disclose all the informations related with the companies, that is their financial statement, their policies, their various types of plans and other information that may be crucial for the prospective investor to take a decision whether to invest into the company or not. Whereas in FPOs, usually less intensive disclosure requirements are there as compared to the IPO, because in case of the FPO, the company is already listed to the stock exchanges, so the company must be following all the criteria and regulations that have been laid down by the SEBI regarding the disclosure of information rule. The next difference is the impact on shares. So in case of the IPO, the new shares are introduced into the market. So all the private companies, those who want to convert themselves into the public company, they can take the help of the IPO for having more financial resources from the market. So they are introduced into the market and the companies are listed into the stock exchanges. Whereas in case of FPOs, the existing shares are sold or the additional shares are issued for generating larger amount of funds from the market. If I talk about the dilution of ownership, in case of the IPOs, there is no dilution of existing shareholders that takes place in case of the IPOs, whereas in case of the FPOs, the offering may be dilutive, and in that case the dilution of ownership may be possible. So we had discussed in the case of the FPO that there are two different kinds of FPOs. They are non-dilutive and dilutive FPOs. So in the case of dilutive, the ownership of the existing shareholder may also dilute into the market. Now let us discuss the regulatory frameworks related with the FPOs in our country. So in case of the FPOs, the various regulations are governed by the Security Exchange Board of India. So companies need to meet with the various regulations that are made by the SEBI, the stringent guidelines, disclosure of the financial information and different other kind of audit requirements needs to be fulfilled before entering into the market for launching the FPOs by the company. So for getting a green light from the SEBI, you need to fulfill the various type of requirement that the SEBI has declared for the companies. The price mechanism is also very different as compared to the IPOs in case of the FPO. So the pricing in FPO is generally more transparent as compared to the IPOs, since the company is already in public for the trade purpose. So on the basis of historical trading data, the financials of the companies are already available. That makes it easier for the investor to evaluate the offer, and price mechanism becomes easier as compared to the IPO in case of the FPOs. If we talk about the risk and return, investing in an FPO comes with its own set of risk and rewards also, and it is generally considered as the less risky as it is compared with the IPOs, because the company is already publicly traded before as compared to the case of the IPO, as well as the investors are well informed about the various types of details regarding the company's financial information. So wealth of information and performance is available already about the company. In such cases, the risk involved into the investment decision making may be lesser as compared to the initial public offering. Now let us discuss about the procedure, how we can apply for the follow-on public offering. So for follow-on public offering, if you want to invest into, then you need to first review. So in order to apply for the FPOs, you need to start reviewing the prospectus of the company, and you need to carefully analyze the various informations that are mentioned in the prospectus of the company. This particular procedure will help you to understand that what is the financial position of the company, what are their future financial plan, and accordingly you can understand for what purpose your money will be used and whether it will be going to give you good rewards in the future or not. The second step of applying for an FPO is to open the Demat account. So by having a dematerialization account, you can trade into the securities. So this is a initial requirement that we have discussed in the previous modules also for trading into the security market. So you need to open a bank account and Demat account before applying for an FPO. After that, you need to follow the application method. There are basically two methods of application, online or offline. You can choose either of them based on your convenience. Then you need to submit your application form by filling it either in online or offline form. So you need to fill in the various required information, and you need to make the required payment, and you need to submit your application form for applying into the FPOs, and after that the allotment and listing takes place. So finally, after the submission of the application form, the company takes into consideration what different volume of applications they have received, and on the basis of the applications, the subscription of the share is done, and finally the allotment takes place. So allotment results and listing details are communicated by the company to the investor. So all this procedure takes place with the help of the clearing corporation. So this is the various details regarding the IPOs and FPOs. In the previous modules also, we had discussed the various details regarding the new issue market and the procedure of raising funds for the companies from the secondary market and the various types of financial instrument that is available to the investor for investing into the company. So with this lecture, I hope now you must be understanding the IPOs and FPOs, and you can take either of the two methods for investing your money into the companies and have good financial wealth into the future. With this, we come to an end of our lecture. Thank you.